So the Fed decided to drop interest rates today as expected, but there are two other happenings that could combine with the Fed's decision that would likely drop mortgage rates in the coming months. Welcome to Dre's Take. Hey folks, I want to start off by wishing you a happy Halloween. I want you to have a ton of fun this weekend, but remember to stay safe. Now, I want to acknowledge the Fed's decision today to reduce their benchmark interest rate by 0.25%. And as always, I do have to say that the Fed interest rate is not the same as mortgage rates. If I don't say that, I know somebody will jump on the comments and make sure that they do remind me. So let me make that clear. However, as lower borrowing costs make their way through the broader economy, we do tend to see some correlation between the Fed funds rate and mortgage rates eventually. But more importantly today are two other key happenings. Number one is the push from the FHFA Director Bill Pulte to review loan level price adjustments, which could reduce the gap or difference in mortgage rates that borrowers see at varying credit score thresholds. And number two is the talk from the Federal Reserve around ending its quantitative tightening policy that would drive down yields and therefore mortgage rates. These three things could combine to create the perfect storm for mortgage rates to finally fall below 6%, prompting Fannie Mae to readjust their mortgage rate prediction to 5.9% by year's end. Some Fed officials and economists do worry, however, that fast falling mortgage rates could accelerate price appreciation and offset any would-be affordability gains from the lower mortgage rates. So here's my take. We can't control what the Fed decides to do, and we can't control how the broader markets react. What we can do is have the foresight to know the potential effects of those decisions and use that information to make the best decisions for ourselves. With that being said, I believe that another window of opportunity is opening for potential buyers. And so there will likely be a gap from the time that rates come down and demand spurs and pricing accelerates, which would create the perfect little window for a would-be buyer to take the most advantage of the situation and gain the greatest affordability gains from the lower mortgage rates. That window of opportunity would likely be just before the onset of the traditional buying season, which is typically in the spring through summer months. And so I would venture to say, if I were a betting man, January of 2026 just may well shape up to be the most ideal time in the foreseeable future for a buyer to make a move. Now, you'll want to start that conversation and get that game plan going before that time hits, so you're ready to hit the ground running when that time comes. And if you're ready to start that conversation, feel free to reach out. I'm always happy to help. And for now, that's Dre's Take. I'll catch you guys next week. Take care.